You decided a captive insurance company may be the right fit for you, but the IRS says in order to become a valid insurance company, you need two things: risk distribution and risk shifting. Hi, my name is Wes Sirk, and I'm the president of Risk Management Advisors. In this video, we're going to be going over what is risk distribution and specifically how do risk pools work. So the IRS said in very consistent tax court rulings that in order to be considered an insurance company, you need two things: risk distribution and risk shifting. Risk shifting is very easy to achieve. You shift it from the balance sheet of the company over to the captive insurance company. Now, risk distribution is a little bit harder. So in IRS Revenue Ruling 2002-89, the IRS has a safe harbor for considering whether or not your risk is distributed adequately enough. And the first one is if the owner of the captive or the captive insures 12 or more separate entities where no entity has more than 15% of the risk or no less than 5%. The second test is 50% independent or third-party risk. So we're going to be specifically talking about how many companies and many clients don't have 12 or more entities and have to get their risk distribution from risk pools, and what does the IRS say about that? So if you're watching this video, you've probably seen your insurance premiums go up and up and up. We have many clients across many different industries that have been searching out captive insurance companies because the surge in premiums across many different industries. So one of the options they have is setting up their own insurance company instead of paying, or in addition to paying, premiums in the traditional market. One requirement that the IRS says is you need risk distribution. You need to have enough independent risks that are unrelated that can be pooled together to get the law of large numbers. The IRS says you need the law of large numbers. So think of a company like AIG. They have many different clients and many different policies over many different geographies, spanning many different years. So they have a lot of different people all contributing premiums at different times to spread the risk around. So for middle market to large market companies, it can be difficult to satisfy this requirement within their own captive insurance company. But a popular method is risk pooling, where a number of captives come together and their risks are blended and shared. So in this, participant captives pay a portion of their direct written premium to the pool to buy reinsurance for their losses. They then assume an equivalent amount of risk from all of the other captive participants in that pool. And this was designed really after the IRS, as we mentioned before, created Revenue Ruling 2002-89 that said captives need, if they don't have 12 or more separate entities, the safe harbor is 50% third-party risk. So a risk pool has to be set up by a captive insurance manager, and that independent pool has governance and controls in place to make sure that that independent pooling insurance company is economically viable and stable. They need to provide timely and accurate reporting to all of the members. They need to be able to demonstrate underwriting control with new and renewing participants. And like I said, maintain the financial strength of the pool. So the pool has to be independent, has to be run with its own separate books and records, and the pool manager has to protect all members equally, and no member takes precedence over another member. So the risk pool also must demonstrate risk distribution. This requirement does not just fall on the individual member captive. The pool itself has to meet the same distribution requirements by having an even spread of risk amongst all of his members. So that's an important concept, and that's what got some of these pools into trouble, when they don't have enough members in the pool to illustrate that they've distributed the risk evenly amongst all the members of the pool. it's not only the captive that comes in that's putting 50% of their risk to the pool and then taking out their pro rata share, but the pool itself has to have risk distribution also amongst all the members. So it can't work where there's one very large member and then a bunch of small ones, because you can't get risk distribution adequately in that scenario. One key is that the individual participants, they have to know that they're taking risk from other companies, and they may not understand the type of risk that they're getting or the industry in which they're assuming risk from. But that's a key component of risk distribution. It has to be many different companies over many different industries. One of the IRS's main issues, and in my next video, I'll be going over the disadvantages of risk pools, but it needs to be run so that no member takes precedence over everyone else. It needs to be managed in such a way where it's paying claims. It's not just a wink and a nod, like we're taking some of your risk, but you're never going to submit a claim. And if there is a claim that goes to the pool, it needs to be done. That claim needs to be processed on a timely basis. This isn't a wink and a nod that, we're just doing this so we can get the tax deduction from our captive insurance company. Another key thing with pools is, I talked about earlier how it has to be legitimate premiums for legitimate policies. Now, there are some pools that only take, the IRS says you need 50% third-party risk. So the captive takes, on $1 million policy, the captive takes the first $500,000 and the pool takes the last $500,000. That does not work, and it's been shown in tax court not to work, because the IRS says the first $500,000 in risk is much more expensive and likely to happen than the second $500,000 in risk. If it's a legitimate risk pool, the captive should be sharing their risk 50% from $1. It should not be an excess loss where the captive takes the first $25,000, the next $25,000 is in the pool, and then the captive comes back on to insure the rest. It should be $1. So if there's a $100 claim, the captive pays $50 of that claim. The other captive participants in the pool pay their pro rata share of that $50 claim. If it's $1 million claim, the captive pays $500,000, and then the other captive participants pay the pro rata share of the other $500,000. That is the only way that these can work. Thank you again for watching. My name is Wes Sirk, President of Risk Management Advisors, a risk strategies company. We're always here to help. We just redone our 2020 Ultimate Guide to Captive Insurance Companies. Put a comment down below and say you'd like a copy of the 2020 Ultimate Guide to Captives, and we will make sure that we send you a direct message that has a link where you can download that Ultimate Guide to Captives. If you have any questions, comments, concerns, feel free to put those down below and I will answer your questions. And then also, we love having phone calls. Make sure you feel that you can always reach out to us to ask a question about captives. If you are an advisor, reach out to us. If you're a CPA, reach out to us. If you're a business owner thinking about captives and want to know whether or not this is the right fit for you, the number's down below. Please reach out to us. We'd love to have that conversation. Thanks again. Thanks for watching. Once again, Wes Sirk, President of Risk Management Advisors, a risk strategies company. Have a great day. Bye-bye.